Financing for Development, Unlocking Investment Opportunities. Project Finance for Infrastructure with Richard Abadie.
What is the process by which investors or developers go through to build up their financing case and to attract that investment? It's equivalent of your neighbour coming knocking on your door and asking to borrow some money to either build a new house or to build an extension to his house. One of the reasons you may want to even have that type of conversation is there's an opportunity to make money at the end of the day. And that would be a motivating factor in potentially lending your neighbour money. You wouldn't just do it out of goodwill. And that's not different to infrastructure. It's a question of what is the motivation and the drive at the end of the day, lending to projects, or in this case, lending to your neighbour to build a house. And when you look at it on that basis, you would be asking yourself questions such as, where's his income going to come from to repay you? What type of risks are there in the loan that you've given him? Will he be using proven contractors? How long will it take him to build the extension or the new house? How's he going to cover the operating costs and the lands and the rates and the taxes? All those type of questions that you would ask in your personal capacity in lending money to a third party to build something are exactly the same questions that lenders will ask in looking at an infrastructure project. They do look at the worst case scenario. They have to hope for the best, i.e. they get their money back and everything's okay, but you also have to plan for the worst. So there's a lot of downside sensitivity analysis as to what happens if material prices go up, if there's delays in schedule because of bad weather and so on. In making those lending decisions as you would in your personal capacity to see if you'll get your money back, project finance lenders do exactly the same thing in infrastructure. The investment decision, so rather than the financing decision, the investment decision, and that is focusing on things like the construction activity. How much is it going to cost? How long is it going to take to build? Who's going to be supplying the materials? What type of risk is there on both the supply of the materials and the price of those materials? What's the quality that at the end of the day you want this infrastructure asset to be built to, because that has an impact on price and quality and who could ultimately deliver it. So those are questions you look at in the investment decision around construction. And then obviously because it's a long-term asset, you've got to look at all the other areas as well, like operating costs, the specification to which you want to maintain the assets. And maintenance is a key issue because you want your asset to continue performing at a sustainable level. And there's other areas as well, such as insurance, the cost of running companies, the cost of permits, licenses, and the like. All of those have to be built in and factored into that investment decision in the first place. So when we look at the financing decision, after we've made the investment decision, there's a couple of factors to consider. And it's something that companies in particular in building infrastructure look at all the time. The very first question they'll ask themselves is, do they have the financial resources to build this infrastructure asset on their own balance sheet? Clearly, if they do use their own balance sheet to raise the money to invest in the infrastructure project, it acts as an inhibitor. It impacts their free facilities or their facilities to invest in other projects. It also impacts their credit rating potentially, i.e. their ability to raise more money. So what we often see in infrastructure projects is that because of the size of the project, companies themselves are not willing to do the project through corporate means, and they look to the world of project finance to enable them to raise and to finance the project. So it gets into the obvious question, well, what is project finance? Project finance basically means raising money in a special purpose vehicle, so it's ring-fenced money, that has no recourse or very limited recourse to the original sponsor of the project. So that means it's no longer done on their balance sheets, it's done off their balance sheet. When something goes wrong with a big mine or oil and gas platform, for example, it severely impedes the ability of that company to pay the shareholders, to pay their creditors, to enter into new ventures. So project finance is often used, even though it could be affordable on companies' balance sheets, to actually take it off balance sheet to ensure that they're not encumbering the company's ability to do further work. The other area, which will obviously make sense, is where there's risks in the project that the company is unaccustomed to dealing with or managing or mitigating. So what they don't want to do is expose their own balance sheet directly to that risk. An example would be, say, a water utility that is accustomed to doing routine maintenance and replacing pipes on a network, which they do on a systematic and regular basis. The actual capital spend on an individual pipe is quite low, but because they're doing it for a whole year in refreshing and renewing a program, the individual risk of one big event going wrong and impacting the company is quite remote. When you have to build a brand new, say, sewage outlet or a reservoir or a storage tunnel, what you will find is that very substantial capital event is something that you are unwilling to expose your shareholders and your lenders and your customers to. So you would probably put that into a special purpose company and try and attract finance into that to make the risk to your balance sheet quite remote. The way this would be done is that an individual company remote from your company would get a license or a right to develop the project. They'd either be paid by the customer directly, or they would be paid by you as the corporate who's acting as the sponsor for the project. And that particular company would go out and, through a procurement process, look to find a builder for their asset. They'd look to find somebody to operate and maintain the asset, and some finance, both debt and equity, to finance the project. The first source of capital you go out and you look for is debt in the marketplace. So what you will do as a developer in a project finance structure is you will look at your cash flows, you'll run some sensitivities on them. In other words, what can go wrong? You look at some of the downsides, and then you'll take that as a package to a lender and go, I'd need to raise some money. This is the type of money I'm looking for, and these are the risks that you as a lender will be taking. Clearly, from a lender's point of view, they want to ensure that the possibility of them not being repaid is quite remote. So they will look at lots of the downsides and worst case scenarios and making a decision as to how much to lend. And when you look at infrastructure projects, the lenders are normally lending on that basis with a degree of conservatism, somewhere between 50 and 90% of the total money needed to build the asset in the first place. So clearly there's a shortfall of somewhere between 10 and 50% that needs to be found from alternative sources besides the lenders to the project. And that traditionally comes from the original sponsor of the project through equity investment. And that equity investment clearly gets paid only and after the lenders have been paid. In certain developed markets, that financial engineering has become quite sophisticated, and there are payments that flow before lenders are repaid. But as I say, it depends on the project, depends on the risks that are being taken. So the key point is that when you are looking at project financing, one of the benefits is you normally can put a lot of debt into the project, which you otherwise wouldn't put onto your own balance sheet. But you've got to make sure that the structural regime that's around risk is well understood and allocated to parties that can bear to manage those risks. And that normally happens through construction contracts with strong builders, operating contracts with operators of that infrastructure who are experienced and able to manage the asset, have a good degree of ability to predict what the likely costs will be. So it's quite a tight package. And the lenders, in asking all those questions, will do some due diligence on your estimates as a sponsor or as a borrower, and just to make sure that they're comfortable within themselves before they put any money into the project. Governments and regulators may decide to put some of their own money into projects and not only use private sources. Pretty often, the reason is that they want to try and keep the tariffs or the charge to customers down. So government will look to, in some shape or form, and I'll cover these, contribute to de-risking the project so that you use less private money, but you use some public money in developing the infrastructure as well. We have seen that in many jurisdictions where effectively, if you look at it on a tariff basis or viability gap funding basis, the decision is taken that the revenue that can be extracted from the project by the concessionaire or by the private sector developer is insufficient to repay the money that they'll borrow and invest from the private sector that is then used to build the asset in the first place. So the tariff system is not enough to repay the lenders. The private bidders are invited to propose a subsidy, a capital subsidy to government that will make the project viable for them. And that capital subsidy is injected at different points in the construction life cycle, upfront, over time, or at the end of construction, to reduce the private finance burden and therefore to make the project, once it comes out of construction, financially freestanding in its own right. That's the first one. capital subsidies. The second one is operating subsidies. Often operating subsidies are used instead of capital subsidies, although they can be used together. But the reason for using operating subsidies in place of capital subsidies is that the government can pay that obligation out over, say, 20 to 30 years rather than over the, say, 3 to 5 years of the construction period. So often it becomes an issue around affordability for the government or the contributing entity around where and when they can afford the subsidy. So there's really a trade-off between the first two of capital and operating subsidies. The third one that is pretty common as well, and it's often a case where government itself doesn't have the fiscal means to put in these subsidies, either directly or indirectly through capital or operating grants or subsidies, is through government acting as a guarantor. From time to time, government's estimates of how many people will use the asset are higher than the private sectors. And as a consequence, the lenders and investors are not prepared to use those assumptions in developing their business case and making their investment. Government, if they're confident in their own estimates, would then turn around and agree to underwrite or to guarantee, say, some of the demand on the asset to the levels that they feel confident will be deliverable. And that would encourage investors and lenders to come to the project because they're not taking the full demand risk or patronage risk or consumer risk on that asset. The other one is directly guaranteeing the finance, and that does happen in many countries as well, where if there's a whole business case prepared, people lend and invest against that business case. But even in that scenario, given some of the concerns of the lenders and investors, they just look for a direct guarantee from government to repay that debt. The other one, which is becoming increasingly common but complicated, particularly in developing markets, is we find a situation where lenders to projects, even though it's, say, a 30-year project or 30-year contract or 30-year franchise, the lenders themselves are unwilling to lend out for that length of time. And as a consequence, what's happening is that you sign a contract as a private developer for a 30-year contract with government, but lenders say only prepared to lend to you for 3 to 5 years. Now, at the end of that 3 to 5 years, there's a significant risk that you as a borrower, the investor in other words, goes into the market and tries to refinance your debt. And at that point in time, the risk for the lenders to the project maybe is that the market has disappeared like we've had through the global financial crisis, or that the terms of refinancing and raising debt have gone up significantly. Those type of risks are risks that are very difficult to pass on to the customer at the end of the day. Sometimes investors and importantly lenders aren't prepared to fully bear that risk. So what you will see is governments occasionally stepping in to guarantee refinancings in whole or in part. So that's another form of government intervention. There's multiple ways governments are stepping in to support projects, but their argument often is, well, how are we coordinating this and why don't we create our own vehicles, government-owned vehicles, to provide debt and equity to projects, or guarantees as well, by the way. And that is quite common. In many of the jurisdictions around the world, we see state-owned banks, such as the State Bank of India, BNDES in Brazil, Banabras in Mexico. These are state-owned institutions that are predominantly there to provide capital to infrastructure programs. But we're seeing a lot of intervention from the states in creating providers of capital to projects as an alternative to providing grants, subsidies, refinancing, guarantees, and the like. There's a lot of talk in the market about using private sources, and there's a lot of initiatives around that, which are great to see, such as the World Bank Group's Global Infrastructure Finance Facility. Private sources of capital alone will never be able to fully finance infrastructure. It's only on a hybrid basis that we stand any chance of coming even close to providing capital from alternative sources to build infrastructure in these developing markets.